If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. The Dominican Republic's economy in 2024 to 2025 displays strong indicators of economic productivity, characterized by robust GDP growth, moderate unemployment, supportive interest rates, contained inflation, and sustainable debt levels. These elements combine to position the country among the more dynamic economies in Latin America. The GDP annual growth rate reached 5.0% in 2024, up from approximately 2.2% in 2023, reflecting a sharp acceleration. In Q1 2025, GDP expanded 2.7% year-on-year, signaling continued, albeit moderated, momentum. Forecasts for 2025 anticipate overall growth near 4.0%, still within high-performing range. These rates significantly exceed regional averages and reflect durable productivity across sectors. Unemployment remains moderate. The official unemployment rate stood at 4.8% in Q4 2024 and rose modestly to 4.9% in Q1 2025, indicating slightly tightened labor conditions as growth persisted. Informal employment remains high in rural and low-skilled segments, but overall, headcount suggests productive absorption of labor relative to output gains. The policy interest rate is supportive and moderate. In mid-2025, the central bank's benchmark interest rate stood at approximately 5.75%, unchanged over early 2025. This rate supports private credit expansion without stoking inflation, balancing growth stimulus with price stability needs. Inflation remains controlled. Annual consumer price inflation peaked at 3.84% in May 2025, then eased to 3.56% by June 2025, staying within the central bank's 4% target band. Stable inflation strengthens purchasing power, supporting consumption and investment, key drivers of productivity. The debt-to-GDP ratio remains moderate. Government debt stood at 57.6% by December 2024, slightly down from previous high levels. Projections for late 2025 place the ratio near 58.7%. Following disciplined fiscal policy without undermining macro stability. Summarizing key macro indicators: GDP growth, 5.0% in 2024, 2.7% in Q1 2025, forecast approximately 4.0% for 2025. Unemployment, approximately 4.8% in late 2024, approximately 4.9% by early 2025, interest rate, approximately 5.75% policy rate. Inflation peaked at approximately 3.84%, easing to approximately 3.56%. Debt GDP stable near 57-59%. These figures demonstrate a productive economic environment. High output growth, moderate labor absorption, conducive financing conditions, stable prices, and fiscal prudence. Sectoral performance highlights this productivity. Tourism and services have been major pillars. Tourist arrivals exceeded 10 million in 2023 and expanded further in 2024, contributing nearly 11-12% of GDP. The services sector, including hotels, transportation, commerce, and finance, grew at an estimated 5.5%, supporting job creation and foreign exchange inflows. Manufacturing and exports also bolstered growth. Industrial sectors, particularly free zone manufacturing, food processing, and mineral exports, grew by around 4.3% in 2024. Export volumes, including gold, cocoa, and ferronickel, increased by approximately 8.9%, driving additional economic dynamism and external balance. Construction and infrastructure investments saw expansion, fueled by public works and private housing growth. Urban development and energy projects bolstered employment and productive capacity. Capital formation as a share of GDP remained high at over 32%, supporting long-term output capability. Remittances and financial services underpin stability and growth. Remittance inflows are strong and support consumption, while the financial sector remains sound with low, non-performing loan ratios. Banking credit has expanded under moderate rates, enabling increased investment in SMEs and infrastructure. Labor productivity is rising. With unemployment near 5%, there is competition for labor in growing sectors. Modest wage gains and investment in workforce skills, particularly in hospitality, finance, and manufacturing. Inflation stability enhances business planning. Controlled headline inflation and contained core inflation allow firms to invest without fear of rapid cost escalation, and households maintain real purchasing power. Fiscal discipline underpins productive expansion. Moderate public debt and manageable deficits preserve fiscal space for infrastructure and social support, while debt servicing burdens remain sustainable. External resilience is maintained. A current account deficit of around 3.5% of GDP is supported by strong export growth, remittances, and tourism revenues. Foreign reserve levels are adequate, shielding the economy from external shocks. Key challenges to productivity include external shocks, global tourism decline or commodity price swings could dampen services and export-led growth, dependency on remittances and tourism, high sensitivity to external demand, and limited export diversification present risk to resilience. Income inequality and informality. Approximately 45% of workers remain in informal employment, constraining inclusive productivity. Rising debt trajectory. While manageable, increasing debt to GDP requires careful fiscal management to prevent structural vulnerability. Policy recommendations to sustain productivity, diversify the export base, encourage growth in agro-processing, light manufacturing, IT services, and near-shoring opportunities, enhance SME financing, lower borrowing costs, and expand credit access for small businesses through public-private guarantee schemes, deepen human capital investment, expand vocational training and higher education to boost labor productivity, upgrade infrastructure, prioritize projects in transport, logistics, energy, and digital connectivity to support productive sectors, improve formalization, facilitate transition from informal to formal employment through regulatory simplification and labor protection reforms, maintain macro stability, keep inflation within target, manage interest rates prudently, and uphold fiscal discipline without crowding out growth investment. Promote inclusive growth, implement policies to share the benefits of productivity gains across income groups and regions. If these strategies are implemented, the Dominican Republic could sustain GDP growth near 4.5%, maintain unemployment near 4.5%, keep inflation under 4%, and hold debt to GDP under 60% through 2026-2027, strengthening its position as a productive emerging economy. In conclusion, the Dominican Republic's economy in 2024-2025 exemplifies productive economic dynamics. High growth, moderate unemployment, supportive interest rates, controlled inflation, and prudent debt levels. The synergy among tourism, exports, services, and remittance finance consumption has created a resilient output base. To ensure inclusive and sustainable productivity, the country must deepen diversification, formalize labor, and invest in infrastructure and skills. With continued strategic focus, the Dominican Republic is well poised to remain one of the Caribbean's most dynamic and productive economies in the near term. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.